The listing went live 4 hours ago. 42 views, 0 calls. You check the phone anyway. You are 24 years old. You have a real estate license, a car with 80,000 miles on it, and a commission split of 70-30 in your broker's favor. Your desk is shared. Your leads are cold. You dial the first name on the list. Nobody answers. The second one answers and hangs up. The third stays long enough to ask how you got their number. You put the phone down. You find the next name. You dial again. There are 30 other agents in this office doing the same thing. Nobody looks up when a call drops. This is level 1. No salary, no floor, no guarantee of anything. You work open houses on weekends. You drive buyers to properties you cannot afford to rent. You smile through every showing. You write 3 offers in your first month. All 3 lose to cash buyers. You write 2 more. 1 accepts. The commission is $5,800. Your split leaves you $4,060. You have been working 11-hour days for 6 weeks. You do not calculate the hourly rate. You know better than to do that yet. By month 8, you have closed $2.1 million in volume. Your broker mentions your name at the Monday meeting. That is the whole reward. A name said in a room. You memorize which agents get those mentions and why. You start arriving early. You stop leaving before the senior agents do. You close your first listing, a $380,000 townhouse on the east side. Your name is on the sign. You stand in front of it before it goes up. You don't tell anyone. You just stand there for a moment. Then you get back in the car. 2 years in. You have a book now. 22 active contacts who call you directly. 1 landlord with 4 units who routes everything through you. That landlord is worth $14,000 a year in referrals if you keep him close. You keep him very close. You learn that repeat business is the only business that scales. Cold calls don't scale. Relationships do. At this level, the second rule: volume is vanity. Margin is reality. 2 closings at $600,000 each beat 6 at $200,000. You stop chasing listings below a certain threshold. You stop apologizing for that. You're running a small team now. 2 buyer's agents, 1 transaction coordinator. Their income depends on your pipeline. That changes how you think entirely. You build a database of 400 contacts. You touch every one of them 4 times a year. A quarterly market update, a birthday note, a referral ask, a value drop with no ask attached. You measure response rates. You adjust. You are no longer selling houses. You are managing a system that sells houses. Your volume hits $18.3 million in a single year. Your GCI is $412,000. Your split is now 90-10 in your favor. You negotiated that. You did not ask. You presented the numbers and waited. Your broker agreed in 3 minutes. You close a $2.4 million listing in a gated community. The seller is a retired surgeon with 3 other properties. You ask once about those properties. You don't push. You wait 8 months. He calls. You list all 3. That's the shift at this level. You stop selling. You start positioning. You take on your first development project. A 4-unit infill in a transitional neighborhood. Total cost, $1.1 million. Land, construction, carrying costs, soft costs combined. You put in $210,000 of your own capital. The rest is a construction loan at prime +1. You have never done this before. You tell no one that. The contractor goes over budget by $47,000. The timeline extends 11 weeks. You absorb it. You do not panic. You make a note about the contractor. You sell all 4 units at stabilized prices. Net profit after fees and loan payoff, $188,000, 18% on a deal that nearly failed twice. You tell yourself you knew what you were doing. You didn't fully, but you do now. The third rule at the developer level: you don't learn from the success. You learn from the $47,000 you didn't see coming. You build your next budget with those numbers already inside it. Next project: a 12-unit mixed-use conversion. Total capitalization: $4.7 million. You bring in a private equity partner for 65% of the equity. You retain development control. You take a developer fee of $140,000 at closing and a promoted interest on the back end. If the deal returns above a 14% IRR, you capture 30% of the upside. The deal closes in 18 months. IRR comes in at 19.3%. Your promote is worth $284,000 on top of the fee. You are 34. Your net worth crosses $1.8 million. You do not feel wealthy. You feel exposed. 6 figures sitting in a deal that hasn't stabilized. Another in permitting. A lender relationship that could go cold if the market shifts. You do not sleep the way you slept at 24. At this level, proximity to capital is proximity to risk. That is the part nobody describes in the pitch decks. You stop doing residential entirely. Commercial now. Ground-up multifamily. Value-add conversions. You have a general contractor you trust and 2 architects you rotate between. A capital markets broker who places your debt. A preference equity provider who can move $3 million in 10 days if the timing is right. These relationships took 6 years to build. They are worth more than any single deal you will ever close. You close a $22 million acquisition, a 96-unit apartment complex, suburban market, 91% occupied, rents 14% below market. You underwrite a 3-year value-add plan, new management, unit renovations, a $4,200 average rent increase at stabilization. You raise $5.4 million in LP equity through a 506C offering. 11 investors. Minimum check size, $100,000. You know every one of them personally. The first renovation cycle hits. 12 units turn over. Renovation cost, $18,000 per unit. The market doesn't absorb the new rents as fast as the model assumed. You extend your hold period by 14 months. 2 investors call you in the same week. You take both calls. You explain the thesis. You hold the position. The rents catch up. They always do in this submarket. You were right. That's not the same as being comfortable. At year 4, the asset appraises at $29.8 million. You return capital at a 1.74 times equity multiple, 16.2% IRR net to LP. You send the wire. You send the report. You already have the next deal in due diligence. You do not pause between them anymore. Pausing has a cost. You manage $94 million in assets now. 3 properties in active value add, 1 in stabilization, 1 in disposition. You attend industry conferences as a speaker. That is a different experience than attending as a participant. The questions people ask you in the hallway are different. The conversations are shorter and more precise. You raise a $40 million discretionary fund. A blind pool? Your LPs are committing capital before you have identified a single asset. That is trust built over a decade of returned calls, honest quarterly reports, and 1 bad quarter handled without spin. Fund 1 closes oversubscribed by $6 million. You turn $6 million away. That is also new. The calls come from different people now. Institutional brokers, family offices. A sovereign wealth fund sends an introductory email through an intermediary. You respond in 48 hours. You meet in person 3 weeks later. 40 minutes. Low-key. Factual. They ask about your underwriting process, your loss history, your dispute record. You answer everything directly. They allocate $15 million to your second fund before it launches. Your second fund closes at $87 million. A UM crosses $300 million. The numbers no longer feel real the way they once did. A $30 million acquisition is a unit of measure, not an event. That transition is quieter than you expected, and colder. You have 3 people who trust you completely. Beyond that, the circle is professional. The deal is never personal. You learned that from a partnership that dissolved in year 6. $400,000 in legal fees. A friendship that didn't survive the operating agreement. You structured everything more carefully after that. The fund's portfolio spans 7 markets, 1,400 units, 4 commercial assets, 2 ground-up developments in active permitting, total equity deployed, $212 million. You have not missed a distribution in 4 years. You review every asset monthly. You know every property by its trailing 12-month NOI, not by its address. A development site comes across your desk. 12 acres. Infill location. Zoned for 340 units with density bonuses attached. The entitlement process will take 30 months minimum. You underwrite it anyway. Land cost, $8.4 million. Total project cost at delivery, $94 million. You commit to the site. You know how slowly it moves. You know what it costs when a city council seat changes. You price that in. You have been through this before. Somewhere across town, a 24-year-old just passed her licensing exam. She is setting up her first CRM, a list of 80 contacts, a broker who takes 30 points off every closing. She thinks this is about houses. She doesn't know yet what it's actually about. The entitlement clock starts. The machine moves forward.